Hi, my name is Darren Joseph HG Tax. We're a team of tax advisors that seek to demystify the sometimes confusing world of cross-border tax. And today I have the honor and the privilege of chatting with Mr. Louis. Louis, you want to introduce yourself?
So my name is Louis. I'm from Singapore.
Uh-huh.
I'm a personal wealth manager, and I deal a lot with, I would say, high net worth and also people from around the region who wants to manage your wealth here in Singapore.
Fantastic. So we have three or four questions which we go through in turn. And the questions were so interesting and so it's questions that are easily misunderstood. So
Yes.
we're just taking the opportunity to record this Q&A and share it with you. Hope it helps.
So the second question is insurance payouts for death or disability or critical illness taxable? Now, most earned and passive investment income is taxable in the U.S. Most foreign earned and foreign passive investment income is taxable in the U.S. However, there are types of income that are excluded from taxable income, such as life insurance proceeds received by the qualified beneficiary, tax-exempt interest, property acquired by bequest, or inheritance, right? So if the insurance contract is deemed to be an insurance product under the law, under the domestic law, in this case is Singapore. So if there's a contract or if there's a policy, which is a life insurance contract under the applicable domestic law, but it does not meet the definition of a life insurance contract under Section 7702, so it's not a U.S. life insurance policy, so it's a foreign one, so it's not an insurance policy as per U.S. domestic law, right? So the amount paid by reason of the death of the insured over the net surrender value of the contract will be deemed to be paid under a life insurance contract for purposes of Section 101. So in other words, the normal rules apply and it should not be taxable. On the other hand, if the insurance policy is from a contract that is not recognized as an insurance policy under domestic law, in this case Singapore, or if the entity issuing the policy is otherwise treated as a PFIC, which we discussed earlier, which is Section 1291 to 1298 U.S. tax code, then the proceeds on death may be taxed as if it were a distribution from a PFIC product, right? Like a regular mutual fund. So in other words, it depends. It depends on whether it's really an insurance policy for Singapore law, generally speaking, or if it is not, and it's a PFIC for U.S. tax purposes, right? So the ownership of a PFIC, as we discussed earlier, can be adverse tax consequences, and it could be while it's being held by a U.S. taxpayer, as well as when there's a payout upon death. So, for example, any deemed disposition of the PFIC, even including when you relinquish U.S. citizenship, so if there's an expatriation or long-term residency or gifting of the policy or pledging the policy of a loan, may result in adverse U.S. income tax consequences under the excess distribution regime, right? The death of the owner may also trigger deemed distribution and result in the same adverse U.S. tax consequences under the same excess distribution regime. So just something to bear in mind. We could probably get into that at some future point in time, but this is a very high level response to the question you posed. Best advice really is to sit with someone who's US qualified and go into the policy and get advice specific to your situation of the policy holder as well as the product.
So if you're a 6, 7, or 8-figure investor, entrepreneur, or business owner who needs a tailor-made solution from a qualified team of professionals, we can help you achieve the international lifestyle, the freedom, and even the tax savings you're looking for. Visit us at htj.tax and live that international life.